in this occasion, we would like to present our presentation about Chapter 4, which is Income Statement and Related Information. Before we do that, we would like to introduce ourselves first. My name is Ghina.
My name is Tika Okta, Yolanda.
My name is Della, Azizah.
My name is Rahma, Marsa.
My name is Ari.
And without any further ado, we would like to begin our presentation. So the first speaker will be Tika. So Tika, time is yours.
Okay, the first is the income statement. So the income statement is the report that measures the success of the company operation for a given period of time. Okay, there are three usefulness of the income statement. The first is evaluate the past performance of the company. So examining revenue and spending indicate how the company performance and allow comparison to its competitor. Number two, provide a basis for predicting future performance. Information about the past performance help to determine important trade with. If they continue, provide information about future performance. Number three, help assess the risk of uncertainty of achieving future cash flow. So information on the various components of income, revenue, expense, gain, and losses highlight the relationship among them. It also helps to assess the risk of not achieve a particular level of the cash flow in the future. And there are three limitations of the income statement too. The first is company omit a time from the income statement that they cannot measure reality. So current practice prohibits recognition of the certain item for the determination of income. Even though the effect of this item can arguably affect the company performance. Number two, income numbers are affected by accounting method employed. One company may depreciation its planned asset on an accelerated basis, another choose straight-line depreciation, assuming all of their figures are equal. The first company will report lower income. In effect, we are comparing apple to orange. Number three, income measurement involves judgment. For example, when a company in good faith might estimate the useful life on the asset to be 20 years, while another company use a 50 years estimate for the same time of asset. Similarly, some company may make optimistic estimate of the future warranty cost and bad debt expense, which result in lower expense and high income. So the next content and format of the income statement will presentation by Ghina.
Thank you, Tika. So I will explain about content and format of the income statement. So there are elements of income statement. Net income results from revenue, expense, gain, and loss transaction. The income statement summarizes these transactions. This method of income measurement, the transaction approach, focuses on the income-related activities that have occurred during the period. Next is elements of financial statement. So there are two elements of financial statement. First is income. Income is increases in assets or decreases in liabilities that result in increase in equity. So the next one is expenses. Expenses are decrease in assets or increase in liabilities that result in decrease in equity. So elements of financial statement, the first one is income. The definition of income includes both revenues and gains. Revenues arise from the ordinary activities of a company. Example of revenues are sales, fees, interest, dividends, and rents. And another income is gains. Gains represent other items that meet the definition of income and may or may not arise in the ordinary activities of a company. Example of income or gains on the sale of long-term assets. Next. The next element of financial statement is expenses. The definition of expenses included both expenses and losses. Expenses generally arise from the ordinary activities of a company. Example of expenses are cost of goods sold, depreciation expense, rent, and etc. And the next is losses. Losses represent other items that meet in the definition of expenses and may or may not arise in the ordinary activities of a company. Example of expenses are losses on restructuring charges, losses related to the sale of long-term assets, and etc. So when gains and losses are reported on an income statement, they are generally separately disclosed because knowledge of them is useful for assessing future cash flow. Intermediate components of the income statement. Companies generally present some or all of the following sections and totals within the income statement. So we can see all of these in our intermediate accounting book at chapter 4. And this is also from the book. Income statement format. So we take an example here of Hong company. So the first one we put into the income statement is sales, and there are so many sources of sales, and then after that we can calculate the cost of goods sold, and then we get the gross profit, and then we put selling expenses, and then administrative expenses, and then other income and expenses, and then we finally can get the amount of the net income. And this is the net income of the year. Condensed income statement. In some cases, an income statement cannot possibly present all the desired expense detail. To solve this problem, a company includes only the totals of companies in the statement of income. It then also prepares supplementary schedules to support the totals. This format may reduce the income statement itself into a few single line of sheet. So this is an example of condensed income statement. As you can see here, there are no detailed explanation about the selling expenses or the administrative expenses, only the total amount of all of them. And then if we want to see the details information about the expenses, we can make the supporting schedules for those who want to see it. So that's all for me. The next presentation is by Bang Andre. Bang Andre, time is yours.
Thank you. So here I'm going to explain about reporting various income items. The first is gross profit. The bulk companies, which company that's explained before, the gross profit of bulk companies is computed by deducting cost of goods sold from net sales. The disclosure of net sales is useful because bulk reports regular sales revenue as a separate item. It discloses unusual or incidental revenue in other income and expenses. As a result, analysts can more easily understand and assess trends in revenue from continuing operation. The next is income from operation. Bulk company determines income from operation by deducting selling and administrative expense as well as other income and expense from gross profit. Income from operation highlight items that affect regular business activities, such as it is a metric often used by analysts in helping to predict the amount, timing, and uncertainty of future cash flow. And next is expense classification. Companies are required to represent analysis of expenses classified either by their nature or their function. So the advantage of using nature of expense method is that it's simple to apply because allocation of expense to different functions are not necessary, and the function of expense method, however, is often viewed as more relevant because this method identifies the major cost drivers of the company and therefore helps users assess whether these amounts are appropriate for the revenue generated. And this is the income statement of Tellaris Group if Tellaris Group uses the nature of expense approach. So there are service revenues, staff salaries, supplies expense, advertising costs, utilities expense, depreciations on building, entertainment expense. And this is the income statement of Tellaris Group if Tellaris Group uses the function of expense approach. There are service revenues, cost services, selling expenses, and administrative expenses. And the next is income before tax. Bokhom company computes in income before income tax by deducting interest expense, often referred to as financing cost, from income from operation. Under the IFRS, companies must report their financing costs on the income statement. The reason for this requirement is to differentiate between the company's business activities, how it uses capital to create a value, and its financing activities, how it obtains capital. And then this is the income before income tax from the network rail, and the total final cost will be 2,200 euro. And the next are net income and earnings per share. Bokhom deducts income tax from income before income tax to arrive at net income. Net income represents the income after all revenues and expenses for the period are considered. And for earning per share, the computation of earning per share is usually straightforward. Earning per share is net income minus preference, dividends, income available to ordinary shareholders, divided by the weighted average of ordinary outstanding. And next is discontinued operation. As we discussed previously, one of the most type of unusual item is discontinued operation. The IASB defines discontinued operation as a component of an entity that either has been disposed of or is classified as held for sale. And next is discontinued operation if it gain. So there will be less in applicable income tax. And the net income would be 245,000 euro. And the next is discontinued operation if it's lost. Well, to illustrate, Multiplex Products, a highly diversified company, decides to discontinue its electronics division. During the current year, the electronics division lost 300,000 euro net of tax. Multiplex sold the division at the end of the year at a loss of 500,000 euro net of tax. And next is allocation to non-controlling interest. A company like Siemens from Deutschland owns a substantial interest in other companies. Siemens generally consolidates the financial results of these companies into its own financial statement. In these cases, Siemens is referred to as the parents, and the other companies are referred to as subsidiaries. Non-controlling interest is that the portion of equity interest in subsidiary to attributable to the parent company. And the allocation to non-controlling interest in companies, when bank prepares a consolidated income statement, IFRS requires that net income will be allocated to both the controlling and non-controlling interest, and this allocation is reported at the bottom of the income statement after net income. So the example of the how book reports is this table. So the next material is accounting changes and errors, will be explained by Della. Thank you.
Okay, everyone, I will explain about accounting change and error. In this material, we have several components. First, change in accounting principle. Change in accounting principle include a change in the method of inventory pricing from pivot to average cost, or the change from an existing accounting principle to a new accounting principle. The next component is change in accounting estimates. Change in accounting estimates are inherent in the accounting process. For example, companies estimate useful life and residual values of their perishable assets, uncollectible receivables, inventory obsolescence, and the number of periods expected to benefit from a particular expenditure. The next is correction of errors. Corrections of errors are treated as prior period adjustment, similar to change in accounting principles. Companies record a correction of an error in the year in which it is discovered. Some summary in this material is the impact of change in accounting principle and error corrections are debited or credited directly to retaining earnings if related to a prior period. Summarize the basic concepts related to these two items, as well as the accounting and reporting for change in estimates. Thank you. For the next material will be presented by Yona.
Okay, I will present about related equity statement. First, retained earnings statement. Net income increase retained earning, and net loss decrease retained earning. Both cash and share dividend decrease retained earning. Change in accounting principle and prior period adjustment may increase or decrease retained earning. Companies charge or credit this adjustment to the opening balance of retained earning. And then, restriction of retained earning. Company often restrict retained earning to comply with a contractual requirement, board of director policy, or current necessity. In some cases, company transfer the amount of retained earning restrict to an account is appropriate. The retained earning section may choose for report to separate amount, retained earning free or unrestricted, and retained earning appropriated. The total of these two amounts equal the total retained earning. Then, comprehensive income statement. In company generally include an income of revenue, expense and change, and losses recognized during the period. These items are classified within the income statement so that the financial statement readers can better understand the significance of various components of net income. And because fair value are continually changing, some argue that recognizing this gain and losses in net income is misleading. The ESB agreed and has identified a limited number of transactions that should be recorded directly to equity. And then,
shown as a final total. The combined statement has the advantage of not requiring the creation of a new financial statement. However, varying net income as a subtotal on the statement is a disadvantage. And two-step approach show the statement format for here. Reporting comprehensive income in a separate statement indicate that the gains and loss identified as other comprehensive income have the same status as traditional gains and losses. And statement of change in equity. Equity is generally comprised of share capital, ordinary share premium, ordinary retained earning, and the accumulated balance in other comprehensive income. The statement reports the change in each equity account and in total equity for the period. The following items are disclosed in this statement. First, accumulated other comprehensive income for the period. 2. Contribution, issuance of shares, and distribution are dividend to owners. And 3. Reconciliation of the carrying amount of each component of equity from the beginning to the end of the period. That's all material for us. Thank you.
So that is all our presentation about this chapter. So from the explanation before, we can conclude that we have learned about first is what is income statement, and then the objective of income statement, and then we also learned about income statement format, and there are condensed income statement, and then we also know that there are various ways to report income statement and the various format of income statement, and also there are also accounting changes and errors, and the last one we just heard before that we also learned about related equity statement. And hopefully all of that knowledge can be useful for us in the future. And that is all for us. Thank you so much for your attention. Wassalamualaikum warahmatullahi wabarakatuh.